In today's market, especially in AI, it feels like you're just drowning in information. It's just so noisy.
It really is. And that's exactly why we're doing this deep dive. We're zeroing in on an analysis report about one company, Rich Tech Robotics, that's ticker RR, because honestly, it presents one of the biggest paradoxes I've seen in a while.
A paradox is the right word, because the market is just screaming panic, right? The stock's getting hammered, but then you look at the numbers and the analysis calls it an impenetrable financial fortress.
Exactly. How does that happen?
I mean, how can a company be panic sold when it's sitting on, and this number is just staggering, $85.5 million in cash with, and this is the kicker, absolutely zero debt?
That combination it's basically a unicorn in the small cap AI space. So our mission today is to really dig into that disconnect. Is this a falling knife you shouldn't touch? Or because of that financial strength, is this maybe the most undervalued AI stock on the NASDAQ Q right now?
Okay, so to figure that out, we have to be methodical. We'll look at the price action causing the panic, then the financials that make it a fortress, and this is key, the products that are supposed to justify it all.
Sounds like a plan. Let's start with where the fear is coming from, the stock chart itself.
Right. So the analysis report shows it trading around, what, $3.36? And it just got crushed down almost 8% in a single day.
And it wasn't a gentle slide. The report nails it, calling it a classic gap and crap.
Explain that for everyone. What does that mean in practice?
It means the stock opened way lower, around 361, and instead of finding buyers, it just immediately sold off even harder, all the way down to $3.28. That's pure fear-driven selling.
But the report suggests that's exactly where opportunity can hide. When fear is that high, but the fundamentals are strong, it can be a bottom fisher's paradise.
Exactly, because that kind of brutal, fast drop almost always means the technical indicators are screaming oversold, specifically the RSI.
The Relative Strength Index. So for anyone who doesn't live on a trading desk, what does an oversold RSI actually signal here?
It's a momentum gauge, and when it dips way down, it suggests the selling has been too aggressive, too fast. It's emotional. It often means the panic is getting exhausted and the stock is, primed for at least a short-term bounce.
Okay, so the technicals suggest a potential bounce. But that brings us back to the big question. Why is the market panicking in the first place when you look at the financials? Let's talk about that $85 million war chest.
It's the one fact the market seems to be completely ignoring. We're talking $85.51 million in cash. And I have to say it again, total debt, zero. For a company in this growth phase, it's a fantasy balance sheet.
And in today's economy, with interest rates where they are, that zero debt figure is basically a superpower, isn't it?
It's a massive superpower. Think about it. So many other companies are getting squeezed by high interest payments. They're cutting back on R&D. They're laying people off. Rich Tech doesn't have any of that pressure.
They're not paying interest. They're earning interest on that cash.
They're earning it. And they have total freedom. No lenders telling them what they can or can't do. They can be opportunistic, maybe make an acquisition, or just plain outlast competitors who are drowning in debt.
That stability it's an asset that doesn't really show up in the stock price right now.
Not at all. It's an offensive weapon, not just a defensive shield.
Okay, but we have to play devil's advocate. The analysis report is very clear about the big bear case. The reason for the fear, they are burning cash.
And we can't sugarcoat that. Free cash flow is negative. That's the number one risk. But you have to look at the burn relative to that $85 million cushion.
Right.
A company that's scaling up, deploying hardware, and investing in AI. You expect them to burn cash. The real question is, how long is their runway?
And what's the rough calculation on that? If they keep spending at the current rate, how much time does that $85 million buy them?
Well, the report doesn't give a hard number. But if you run a conservative estimate, say they burn 8, maybe 10 million a quarter, you're still looking at a runway of over 2 full years.
2 years. So this isn't a company that's about to go bankrupt next month.
Not even close. What's so fascinating here is they've bought themselves time to execute. And in the AI race, that is priceless. They don't have to rush. They don't have to take bad deals.
Okay, so that financial security is the foundation. Let's shift to what they're building on top of it, the tech. Because a safe balance sheet is nice, but you buy an AI stock for growth.
Exactly. And this is where the real-world proof comes in. Starting with their star product, Adam, the AI robot bartender.
And the most important thing the report stresses is that Adam is not a concept. It's not a prototype. It is out there working.
And working in some very impressive places. You want validation. It's serving cocktails at NVIDIA headquarters.
NVIDIA. I mean, if your tech is good enough for them.
Right. And it's also making premium coffee at Walmart. These aren't just small pilot programs, these are high-stress, high-volume environments. It proves the tech is robust.
So those big-name partners, they act like a huge stamp of approval. It must make it easier to sell to other companies.
It dramatically lowers the barrier to entry for future sales.
Right.
It signals that this isn't some garage startup. This is enterprise-ready technology.
But Atom is just one piece. The analysis also points to something called DayX as the real future growth engine.
This is where it gets really interesting. DayX is their mobile humanoid robot for industrial work. This puts them squarely in the hottest part of the entire AI robotics sector.
The humanoid robot space. We're seeing a ton of hype around that.
A massive amount.
Yeah.
And RR is a direct player. The idea with DayX is to replace expensive, repetitive human labor in places like warehouses. Think about the cost of a specialized forklift operator or other heavy machinery. DayX is aimed right at that market.
So that's the home run swing, but they also have some more foundational products, right? The report mentions Metro D and Dizis TE.
Yeah, those are their service and cleaning bots for hospitality. They're not as flashy as a humanoid robot, but they're critical. They create recurring, predictable revenue streams.
So they're building a stable base while also shooting for the moon with DAX.
It's a smart strategy. It balances the risk. But again, it all comes back to that validation from NVIDIA and Walmart. That's the concrete proof that the tech works, which makes the current stock price seem disconnected from reality.
It really does. It feels like the market is only looking at the cash burn and ignoring everything else.
Which brings us back to the here and now. If you're looking at this as a potential trade, you need to know the key technical levels.
Right. So the analysis identifies a critical support level. The line in the sand is that $3.28 to $3.30 zone.
That's the must-hold level. If it bounces there and holds, that could be the bottom. It sets up a potential double bottom reversal, which is a very bullish sign for traders.
And if it does bounce, what's the upside? Where's the first test?
The first hurdle is getting back to 365. That would fill the gap from that big drop. After that, you're looking at the big psychological number of $4.
Okay, so that's our take. What about Wall Street? Does the report mention the analyst consensus?
It does. And if we connect this to the bigger picture, the analysts seem to agree that it's way undervalued. The average price target is $4.34.
Wow, okay, so that's nearly a 30% upside from here.
And the high target is even more aggressive, $6. That implies a potential 78% gain. So the professional view is clearly that this panic is a massive overreaction.
Okay, let's wrap this all up. Let's summarize the whole bull versus bear argument.
Go for it.
The bull case is, you're buying a real robotics company. It has proven products, incredible partners in Walmart and NVIDIA, and a fortress balance sheet with $85 million in cash and zero debt. And you're getting it near a 52-week low.
The bear case is just as simple. It's unprofitable. It's burning cash. The price is low for a reason. This is, without a doubt, a high-risk, high-reward swing trade.
So the final verdict from the analysis seems to be about belief in the long-term story. If you believe the AI robot revolution is coming, then getting a company with this kind of validation and a multi-year cash runway at 330, it looks like a steal.
The key is watching for that bounce.
Yeah.
You want to see it hold that 330 support level. That's the signal that the panic might be over.
It's just the ultimate showdown, isn't it? An unprofitable growth engine versus an impenetrable balance sheet. So what does this all mean? That's for you to decide.
And I think I'll leave you with one final thought. That financial fortress, the cash and zero debt, it provides safety. But the future value is all about execution. That runway is long, but it isn't infinite. So the question isn't just if the AI revolution is coming, but how quickly can RR turn that validation from NVIDIA and Walmart into real, significant, and profitable revenue? Which raises a really important question. How valuable is zero debt if the cash eventually runs out before you hit profitability?
A question to keep in mind for sure. Thanks for joining us on this